Okay, how to calculate depreciation. So we are going to, bear with me, we are going to learn how to compute depreciation using one of three methods: straight line, units of production, and declining balance. Usually it's referred to as double declining balance. Okay, but just as a recap, our depreciation expense and accumulated depreciation is the difference between the cost of the asset and the residual value or the salvage value, right? How much it's worth at the end, and then how much it's declined over time. But the difference between the original cost and the residual value, the estimated residual value, that is what we are referring to as depreciation. And then we are saying there's three methods to calculate this decline, and that would be straight line, units of production, and I'll just call it double declining balance. Okay. In this video, I am only going to talk about straight line depreciation. And then I will do two subsequent videos that talk about units of production and double declining. So in this video, let's do straight line. When I'm using any one of the three, okay, the three inputs that we want to use to calculate depreciation in any one specific year, it's always going to be the same three inputs: cost, salvage value, and useful life. And that's what I was trying to articulate in this. We're going to use cost, residual value, and then time or units, but this is essentially useful life. Okay? So straight line has a very specific formula, and the formula for straight line is literally this right here. Okay? It is the cost minus a particular estimated salvage value, right? What it's going to be worth at the end of its useful life. And then we're going to divide by the number of useful lives or the periods within the useful life. So in our particular example, let me move my hideous picture. But in our particular example, we're saying, hey, listen, we're going to buy an asset, a long-term asset. We're going to pay $10,000, and that includes all of those costs that we spoke about in the previous video. When we're done using this particular asset, we think that the salvage value is $1,000. And so the difference between the two, we're basically saying we expect this to depreciate by $9,000 over its useful life, right? If I have $10,000 over here and 1,000 here, we're saying that it's going to decline by a total of 9,000. Okay. And we're going to spread that over 5 periods, and therefore we divide by 5 years. And what we're saying is 9,000 divided by 5 years is $1,800 per year. So every year, this asset is going to decline by 1,800. The journal entry to record each year's depreciation expense is going to be, again, depreciation expense. That is the amount by which we depreciated this particular asset in this period, and that goes off to the income statement. And then accumulated depreciation, that is all of the depreciation over the asset's useful life. Now what we're saying is we are adding 1,800 to that running total, but we're only adding 1,800 from this year, and that goes off to the balance sheet. Don't want to get into that one, but essentially this is the original cost right here, and then every year we're going to depreciate by 1,800. Okay, and so in year one, our accumulated depreciation is only 1,800, But in year two, right, in 2022, we're saying our annual depreciation expense is 1,800, and therefore our accumulated depreciation is 3,600, and therefore book value, our book value is again the cost minus all the accumulated depreciation. And so our original cost was 10. All the accumulated depreciation through the second year was 3,600. And so our book value, 6,400. And then we get through year five, the total depreciation that we've taken, 9,000, which is what we were saying we would take. Therefore, the original cost of 10,000 minus all the accumulated depreciation through the 5 years is 1,000. Sorry, is 9,000. 10,000 minus 9,000 is the $1,000 residual value that we anticipated at the onset of this example.